We're going to carry on with Chapter 16, Fiscal Policy, and I'm going to spend a few minutes recapping our last lecture. So please note that we are jumping around a little bit. We're not following the sequence of chapters in the book. Okay? So we did Chapter 14, which was the aggregate expenditure multiplier, and then we jumped to Chapter 16. That is the, I believe, the natural way one goes through these chapters. Fiscal policy. So in our last class, we discussed the phenomena of crowding out. And when does crowding out take place? It's when an increase in government spending causes the sum of the other three spendings to go down. Correct? So this is the phenomenon of crowding out. And what it does is, of course, reduces the effectiveness of fiscal policy. Why does it reduce the effectiveness of fiscal policy? The following diagram makes it clear. Real GDP, the price level, aggregate demand, aggregate supply. Equilibrium GDP in this economy is Y star, whereas full employment real GDP or potential GDP is YF. We have a recessionary gap which must be narrowed by the means of expansionary fiscal policy. What does expansionary fiscal policy mean? Policy designed to expand AD, hence equilibrium GDP. Hence, it's called expansionary fiscal policy. So let's say the government pursues expansionary fiscal policy and raises its spending. Right? Now, this, as we've learned, is going to cause the AD curve to shift rightward like this. According to the theory that we learned in Chapter 14, the aggregate expenditure multiplier, this horizontal shift rightwards, is going to be many times the increase in government spending. You have a multiplied effect on aggregate demand of an increase in government spending, is what we learned in Chapter 14, correct? But now, because of crowding out, because the other three spendings are going to go down, we have a movement back to the left. So we have a movement back leftwards. So you might think of this as a two-stage move. We have a move from the black AD curve to the red one first, and then a movement back leftwards to the blue one. And this is because of crowding out, correct? So this movement here is because of crowding out. The fact that the other three spendings have gone down. So clearly, the effectiveness of fiscal policy has been reduced. You see, the government aimed to shift the AD curve from the black one to the red one. That was the ambition of the government, right? But it didn't work out like that. In the end, all the government could do was shift it from the black one to the blue one, not the red one. See? So fiscal policy, so crowding out then reduces the effectiveness of fiscal policy. So this is what we learned in class last time. So what are we going to do now? We're going to get into some details of fiscal policy. Now, fiscal policy can be broken up into two types. Now, once again, recall that fiscal policy is in the hands of the government or the Fed. Can somebody answer that? Who's in charge of fiscal policy? Is it the government, by which I mean the executive branch of government and Congress? Or is it the Federal Reserve Bank that controls fiscal policy? The government, exactly. So fiscal policy is under the control of the government, by which I mean the executive branch, meaning the president, and the legislature, which is Congress. These are the guys in charge of fiscal policy. And what does fiscal policy involve? We've mentioned this before, but I'm repeating. All decisions about government spending and taxes. So that's fiscal policy, correct? And now I was saying that you can think of fiscal policy as being broken up into two types. And these two types of fiscal policy are automatic fiscal policy, right? And discretionary fiscal policy. So let's talk about the distinction between automatic fiscal policy and discretionary fiscal policy. So what is automatic fiscal policy? This is fiscal policy that kicks in without any deliberate action on the part of the government. So this is without any deliberate action of the government. This is fiscal policy that happens automatically. Now, when there is a recession, when we have a recession, what kind of fiscal policy is called for? When there is a recession, what kind of fiscal policy do we need? We need expansionary fiscal policy. Is that correct? And what does expansionary fiscal policy involve? Government spending, what, going up or going down? Government spending going up or going down, somebody? Going up, clearly, because we want to shift the AD curve rightwards. We want to increase demand in the economy, correct? So government spending would be going up, and taxes would be going down. This is what is required in a recession. This is the kind of fiscal policy that is required, correct? Now, this or some of this happens automatically, and let me tell you how. A large part of government spending consists of what are called spending on income support programs. This is a large part of government spending. Now, what is spending on income support programs? This would be basically assistance to the needy, broadly speaking. So this would be government spending on helping people who've fallen on hard times, the poor, for instance, or the unemployed. Correct? So this is one large component of government spending. Now, what do you think happens to this spending during recessions? What happens to this category of spending in a recession, do you think?
It would go up.
Yes, it would go up, exactly. And why would it go up?
Because there's more needy people.
Because there are more needy people, exactly. There are more eligible people. More people become eligible for government assistance during recession. So during recessions, what happens then? Automatically, this kind of spending tends to go up in a recession. This happens automatically. This happens automatically because more people become eligible for these income support programs. Right? So what am I saying here? Remember, I'm discussing the automatic aspect of expansionary fiscal policy. In a recession, An increase in government spending is called fall, correct? Some of this happens on its own, is what I'm saying. Some of this happens on its own because more people become eligible for government assistance during recessions. And so government spending automatically rises. And this, in a sense, helps bring the economy out of recession. Now, this is something that the government didn't deliberately do. It just happened automatically. Is that correct? Okay, what about taxes? Now, a large component of taxes are basically personal income taxes, taxes that you and I, households, pay. And these are typically a percentage of income. It's not a set percentage. We don't have a very simple tax code in this country. Right? There are some countries where you have a very simple tax code. Everyone pays 20%, for instance, of their income. Whether you're rich or poor, you pay 20% of your, or 25 or 30, whatever it is. Some flat percent rate. Everyone pays the same rate. And there are some countries out there that follow this very simple tax code. The US tax code is notoriously complicated. Lots of loopholes, lots of, the US tax code is a thick, thick book of rules, right? So it's not a percent of income, really. It's some sort of a sliding scale. If you make a small income, then you virtually pay no tax. Sometimes you pay a negative tax, which is to say the government gives you money, right? On the other hand, as you start making more and more income, you start to pay a certain share of your income as tax. Now, this is a sliding scale. You might pay 10% at the beginning, and as you make more money, you pay 20%. And as you make even more, you pay 30%. I think the top tax bracket in this country is about 33%, something like that. And I'm not a tax accountant, but it's something in the vicinity of about a third of your income. So if you're a doctor or a surgeon or somebody, you're paying about a third of your income as taxes, right? All right, so now again, would this behave automatically? Now remember, in a recession, what do we need? We need taxes to fall, right? Now, what happens in a recession? In a recession, people's incomes fall. Am I correct? In recessions, people's incomes tend to fall. And so if people's incomes fall, what happens to the share of income that the government collects as taxes? What happens to the government's tax revenues, in other words?
It falls as well.
It falls because, you see, the government is charging you a share of the pie, so to speak, the pie being everyone's income. And if that pie shrinks, the government's tax earnings also fall. Is that correct? Right? So what happens here is that in a recession, this is going to fall in recessions. It's going to fall because people's incomes tend to fall during recessions. And so the government's share of people's incomes is going to fall. So what am I saying here about automatic fiscal policy? I'm saying that a rise in G and a fall in T, some of this happens automatically. So the government has to take no deliberate action, just happens automatically. So this is automatic fiscal policy. Right? Another word that's often used is you have an automatic stabilizer. This is an automatic stabilizer because if the economy is in a recession, well, automatically the government spending on income support programs are going to go up, and taxes are going to go down. This is going to happen automatically, and this will jog the AD curve rightwards. So this is like an automatic built-in stabilizer in the economy. A force that will bring the economy back to full employment, or at least tend to do so, automatically. Right? So this is automatic fiscal policy. I hope that's understood. And now let's talk about discretionary fiscal policy. Discretionary fiscal policy is policy that is deliberate. This is something that the government deliberately decides to do. Right? Now, during our last recession, the Great Recession, which began around 2007, 2008. President Obama passed a stimulus package. And the stimulus package, which was a combination, it was a combination of rises in government spending and tax cuts. And the stimulus package was worth about $700 billion. So in our last Great Recession, the government tried to shift the AD curve rightwards by doing this, providing a fiscal stimulus to the economy worth about $700 billion. Right? Now this would be what? Would this be automatic or discretionary? Discretionary. This is discretionary because this is something the government deliberately did in order to help our economy climb out of that Great Recession. Right? So I hope that's understood then. The next thing that I'm going to talk about is the budget balance and the national debt. I'm now going to define a term called the budget balance, the government's budget balance. And the government's budget balance is simply defined as its tax revenues minus government spending. This is the meaning of budget balance. Now this can be a positive number. This could be a positive number if tax revenues are greater than government spending. Right? On the other hand, this would be a negative number if tax revenues are less than government spending. Correct? Now, when this is positive, we say that the government is running what's called a budget surplus. On the other hand, if this is negative, we say that the government is running a budget deficit. Budget surpluses versus budget deficits. Now, give me a sense, and this is something that you may not know, but just depending on how aware you are of the world around you, could you tell me what's been happening to our US government budget, our federal budget? Has it been running surpluses or deficits over the last, let's say, 10, 12 years? Deficits, exactly. So we've been running budget deficits for a long time now. In fact, the last time that our government saw a surplus was during the Clinton presidency. During his time, for a couple of years there, we had small surpluses. But after that, we've been running these huge deficits. Again, what was one contributing factor to these budget deficits? So in other words, they really began after President Bush was elected. And anyway, can someone give me a sense of why we ran these huge, what were some of the causes of these large, the war was one important factor, correct? Because when President Bush came along, we had 9/11, and then the US went to war in both Iraq and Afghanistan, correct? So that means that government spending greatly increased during the Bush presidency. So what does that do then? If you have a big rise in this, a big rise in government spending, well, that would tend to make the budget balance negative, wouldn't it? Right? But it was more than that. We had the war, of course, which is something that really perhaps couldn't be helped, although some will argue that there was no need for the US to go to war with Iraq. There were no weapons of mass destruction found there and so on, right? Saddam Hussein had nothing to do with Al-Qaeda and the people who blew up the Twin Towers. That's an argument that's been made. But besides that, there was something else going on in the Bush presidency, and that is that there were these tax cuts that were also instituted. So you had two things happening. You had government spending going up on the war, but you also had tax cuts on the rich. Okay? So both of these together then, of course, tend to increase any type of budget deficit because we have tax revenues going down and government spending going up, and that, of course, is a recipe for deficits. Okay? So what does the budget deficit lead to? When the government runs a budget deficit, what must it do? What kind of government action is this going to lead to? Now, you might ask yourself this question. If you begin to increase your spending with a decrease in your income, which is what happened during the Bush years, government spending was going up and tax revenues were going down because there were tax cuts on the rich. So this would be akin to your spending going up and your income going down. How would you sustain this personally?
Do it backwards. Get more taxes.
No, in the sense, no. Let's say you can't control those two things, right? How do you manage that? How do you go about your life with your income shrinking and your spending going up? What must you do to pardon me? Well, that's not an option here because, well, yes, in the long term, that would be the correct thing to do, perhaps. But how do you keep this going for a while? Yes, that's what I'm getting at, taking loans, right? So a budget deficit leads to government borrowing. You follow me? So when there is a budget deficit, the government must borrow. That's the only way to keep keep going. Now, how does the government borrow? Does anyone have a sense of that? The government borrows principally by selling government bonds. The government borrows by selling government bonds to the public. So you and I, for instance, may go out there and buy a government bond as a financial investment. By buying the bond from the government, we are giving the government money. We are lending the government money. Because what is the bond? The bond is really an IOU note. It is a promise by the government that it will pay you, the bearer of the bond, a certain sum of money at the end of a specified period of time. You follow me? So the government bond is a piece of paper. It's really it's like a certificate. And in this certificate are two bits of information. You have a date of maturity, and then you have a dollar value. It's called the face value of the bond. So what does this piece of paper do then? It is basically a promise by the government that it will pay you, the bondholder, the face value. When? On the date of maturity or at any time after that. Correct? So this is a government bond. It's a promise by the government that it will repay you at some point in the future. So by buying this bond, you are lending the government money. Correct? So what does all this government borrowing do then? Government borrowing, of course, leads to a rise in what's called the national debt, also called the public debt. Any kind of borrowing that the government does in a year is going to add to all of the existing borrowing in the past that the government has engaged in. In other words, if you use your credit card today, what will that do? Won't that raise the total amount that you owe the credit card company? Right? The total amount that you owe the credit card company is akin to the national debt. You follow me? So the national debt is the total indebtedness of the government. This is the money that the government owes its creditors. Correct? So every time the government borrows, it adds to this national debt. And what is the national debt? The national debt can be thought of as the sum of all past borrowing. right? So we have a rise in the national debt every time we have a budget deficit. On the other hand, if you have a budget surplus, if the government runs a budget surplus, then this gives the opportunity to the government to repay some of the national debt. Because the government can use its savings, its surplus, to pay down the debt. So budget surpluses permit the government to repay some of the money that it owes. On the other hand, budget deficits simply add to the national debt. That's simple enough? And there is a simple formula here that one can employ, and that is the national debt at the end of year T is equal to the national debt at the end of the previous year, year T minus 1, plus the budget deficit in year T. Right? So the national debt at the end of year T would be the national debt at the end of the previous year plus the additional borrowing of the government this year. Correct? The budget deficit this year would be the amount the government has had to borrow this year. So this will simply add up to the debt at the end of last year. And this will give you the total indebtedness of the government at the end of this year. Simple enough, right? And what I'm going to do now is I'm going to quickly show you a website which is a fairly disturbing website. And it's called the National Debt Clock. So all you need to do is Google the National Debt Clock. There you go. National Debt Clock. US National Debt Clock, real time. So what's the US national debt? It's the number that you see on the top left. And you see the numbers, they're rolling over because it's, government's adding to that every second in a sense, right? So what is that number? Now, how many zeros do we have here? That 18, is that a billion or a trillion or what? Yes, that's trillion, right? And then when you divide that by the current population of the US, which is 300 plus million, right? If you do that, you arrive at a debt per citizen of $56,667, right? And if you divide that by the number of taxpayers, there's a difference between the number of taxpayers and the number of citizens because a lot of citizens are kids. They don't pay taxes, correct? Also, a lot of citizens are poor and they don't pay taxes either. So when you divide by the number of taxpayers alone, you get a figure of $154,102 per US taxpayer, right? Now, that's an enormous sum of money. I'm putting this up to give you a sense of just how indebted our government is, right? So what is this difficulty with the national debt? Is it something that we should be worried about, is the question, okay? So let me talk about that briefly now. So we have $18+ trillion of government debt. Is this worrisome? Is the question, correct? How much does a typical American adult owe? Let's say this person's a homeowner. Right? Let's consider somebody in the city of Brownsville, let's say a school teacher. Right? Let's say the school teacher makes, I don't know what the salaries are. I'm going with a ballpark figure here. Let's say $50,000. Pardon me? 40,000. Okay, let's say 40,000. So this is a school teacher who makes $40,000 a year, and let's say this person owns his or her own home, right? And therefore has a mortgage loan. And what value of home would a school teacher earning $40,000 buy? A sense? Give me a rough estimate here. I mean, this is how economists often work. We make these educated guesses. So if you have a school teacher earning $40,000 a year, what value of home would this person buy? Would this person buy a $90,000 home, perhaps? Less? More? Give me a sense. And even be accurate. Give me a. How much? Okay, say $80,000 home. So this is a school teacher who's earning $40K, and this person has bought an $80K home. So how much does this person owe then? What is the total indebtedness of this person? Besides, this person may have credit card debt also, correct? But let's assume this person doesn't have credit card debt, but this person has at least an $80,000 debt. Am I correct? Am I making sense here? Because this person bought a home worth $80,000. Okay, let's assume this person put 20% down, which is what you typically have to do, right? If you put 20% down, so what's 80% of 80K? That's, right? So this is the amount of indebtedness of this person, at least. Am I making sense here? So this is a person earning $40,000 a year, but owes $64,000. $64,000 is bigger than this person's annual income. Should this person be tremendously worried about this? Should this person be worried about this? No, this is normal, isn't it? You earn $40,000, you have a $64,000 home, your indebtedness is more than your annual income. No big deal, am I correct? Right? Now, if it's no big deal for individuals, how come so many people, particularly on the Republican side, are worried about our large national debt? Because our national debt is about $18 trillion, is that correct? Now, what is the nation's income equal to? Is the question we need to ask. Am I correct? Because this teacher's salary, annual salary is $40,000, and this person owes more than her annual salary. What is the nation's annual salary? What would you call that? GDP, correct? Now, could someone pull out their smartphones and help me out with this? I'm going to look for it myself, but I want some of you to look for our current US GDP, the figure from, let's say, last year. So what was GDP in the year 2014? US GDP in 2014. Okay, here you have projections. Yes, 24. Okay, here we go. You see that number there? What does that look like? That's what? How many? What is the unit of measurement here? Unit of, yes, 17.42 trillion. Is that correct? That's national income in current dollars. 17.42 trillion. Am I making sense? So that's national income. What's the indebtedness of the government again? Just a bit more, isn't it? So why should we be so worried is the question. We're not worried about that school teacher who owes $64,000 with a salary of $40,000. And in terms of a percentage, what is 64 as a percent of 40? Can somebody calculate that for me? 64 as a percent of 40? Come on, 64 divided by 40 times 100.
160.
How much?
160.
160. So for that school teacher, the debt to income ratio is 160%. Correct? And what about us? What about the economy as a whole? Would you note down this number here? What was it again? 17416.25? 17416.25. Let's get back to our national debt clock and see what national debt clock. And what we have here, we'll work with a 18.17 trillion. In billion, it would be 18,167. 167.28. Right? Would you mind going 18,167.28 divided by 17,416.25 times 100? What percent is that?
94.38.
No. The bigger number divided by the smaller number. This is the debt indebtedness. Remember, for the school teacher, we did what for the school teacher? We went 64K divided by 40K times 100. Is that correct? So what is this number equal to? Any answers? When it takes this long, there are lots of you just sitting on your hands, really, and that's not participating in class, frankly.
104.31.
Yes, 104.31. So US debt to GDP ratio is 104.31. That school teacher's debt to earnings ratio is, right? I'm just putting things in perspective here, right? For the 160, we're not worried about this person. So why should we be so worried about this one, is the question. Right? This is an argument that can be made, and I think it's a good argument. Now, there are some countries out there that have a debt to GDP ratio that's just far worse. Okay? In fact, we might try to look this up as well to be top 7 countries. We are there, yes, in that top 7, but compare us to, say, Japan. Look at Japan's debt to GDP ratio. It's more than twice their GDP. Am I correct? That's Japan's situation. Now, Japan is not an insolvent economy. It's not an economy in any difficulty as such. Yes, it's suffering from recessions and so on. It has for a while, but it's picking up now. It's certainly not one of the world's basket cases. It's not. It's still a very strong economy. Am I correct? Okay, next, Greece. Now, Greece is a bit of a basket case, because they almost defaulted on that debt, right? Italy, some people are worried about Italy too, in the sense that they have spent far more than they've collected in taxes for a long time now. So some of these other countries, Greece, Italy, Portugal, I would call them countries that are in difficulties, right? What about Singapore? Is that a country that we hear about as being in difficulties? No, it's one of the world's strong economies. It's a big international hub for trade and finance in the Far East. Okay? The US, are we in difficulties? I think it may be a little overblown, the worries. That's my own sense. And that's what lots of economists believe. Right? We're still quite a powerhouse. And, well, we have problems. We have problems. There are opportunities here in this country, but unfortunately, they seem to be limited to those with an education. You follow me? And it's a good thing that you guys are in class today, attending school, because really the fruits are going to be picked by people like you, unfortunately, not by the high school dropouts or high school graduates. They're going to fall behind. Right? And then Belgium. Now, is that a country in difficulties? One really doesn't hear about Belgium being in dire straits. It's one of the European countries that are, in a sense, in the doldrums these days. I mean, their growth rates are probably low. But one doesn't hear about Belgium defaulting on its debt or anything. I'm trying to give you a sense here, a perspective here. Okay? So our debt to GDP ratio is not too bad. It's, according to this calculation, 101.5. We came up with something a bit more, 104.31. Yes? So what's really worrisome about this national debt? Let's talk about that briefly. Okay. Now, one difficulty with this debt, so let's look at the problems associated with the national debt. Well, one problem is that many foreign entities own US government bonds, which means that our government owes money to many foreign entities, and these foreign entities would be private foreign citizens, foreign banks, as well as foreign governments. The Chinese government, for instance, holds a lot of US government bonds. What does that translate to? That means that the US government owes money to the Chinese government. Right? Now, is that something that's worrisome? Well, some people who are say more paranoid than others may say that, well, yes, China is not a friendly country, and if our government owes money to a country that isn't particularly friendly to us, it's not strategically sound. So that may be a worry. But more than that, it's a question of when the debt has to be repaid, this will result in a lot of income, dollars, leaving the States and going abroad. Right? Now, some people argue that if all the US government bonds were owned by Americans alone, in other words, if the US government owed money to Americans alone, things wouldn't be so bad. Now, why wouldn't they be so bad? Let's consider this rectangle here to be American citizens, okay? And let's say that a part of these guys, that part, and I'm going to color it, these are the guys in yellow who have bought government bonds in the past. So these are the people to whom the US government owes money. Now, when the time comes to repay, what is the government going to do? The government, of course, is going to tax the entire box. Right? So the entire box is going to be taxed. And then some of these tax monies are going to be used to pay back the guys in yellow. Right? However, if you think about this, all that's really happening is that you have a redistribution of income within the box. The government's taking money from the entire box and then paying it to the people in that yellow segment. But the amount of money in the box itself is unchanged. So all we have here is a redistribution of income within the box. And this is not so bad. Am I correct? But this is not our situation. Because in our situation, the government has to pay some money not just to the Americans who own government bonds, but some of this money has to go to countries like China. And that will be money leaving the box. Correct? So that is something that may be worrisome then. Another problem with this debt, of course, is that government borrowing, which led to the debt, and this is the last sentence I'll say today, government borrowing, as we've learned before when we discussed crowding out, leads to a rise in interest rates. Is that correct? So what is the appropriate story here? We have here a market for loans, right? Quantity of loans. The price of loans is the interest rate. You have a demand for loans and a supply of loans. And when the government borrows, what happens? The demand for loans increases like this. And that, of course, leads to a rise in the equilibrium interest rate. That's the story. Right? Now, what does a rise in the interest rate do to investment spending in the economy? What happens to investment spending in the economy with a rise in interest rates? Firms' purchase of new machines. Come on. Doesn't it go down? Yes, right? Because firms too often borrow money to buy machines. And if you raise the cost of borrowing, firms are less likely to then borrow money to build new factories, buy new machines. Now, when there is less investment spending, what is the consequence for economic growth? Economic growth very often depends upon the nation's stock of capital, meaning machinery. Now, if businesses buy fewer new machines, this is going to reduce the rate of investment in the economy. And this is going to bring down the rate of economic growth. And that's bad for the economy long run. Fewer jobs would be created, etc. Real GDP would grow at a smaller pace, right? So this is a second problem with a large national debt, because the processes that led to that large national debt, government borrowing, has this negative effect on economic growth in the economy. We will stop here today.